Hello and welcome back to the channel. My name is Peter, and today we're going to go through a list of 5 factors that are going to enable you to successfully predict stock market crashes, or more specifically, periods of economic recession. We're going to be including examples from throughout history, including what led to the 1929 stock market crash and the depression that followed it. So make sure to stick around to the end for that. So the first point I want to cover is the bank tightening standards for commercial and industrial loans. So this is a chart going back to 1992, and this highlights the huge influence that lending standards have on the business cycle. So this is a chart telling you whether or not banks are willing to lend. If this percentage is elevated, it means not many banks are willing to lend. If it's very low, it means conditions are easy. Money is plentiful and businesses are able to borrow money very easily. So you're going to quickly spot the relationship between lending standards and the business cycle. You can see every time the lending standards begin to rise, it leads to a recession. So this is right up to the dot-com bubble. You can see in 1998, 1999, tightening standards were higher, so it was harder to borrow, and that created a recession. Same thing in 2007 here. Obviously, we had other causes for the financial crisis, but the fact that banks were tightening their lending policy between 2005 and 2007 is what created a real downturn. This is what really led to a crash in the stock market, because these bumps right here create contractions of credit. And when you have a contraction of credit, that's when asset prices go down. So if there's one thing you're going to take away from this video, and we're going to discuss it in more detail in just a couple of minutes, it's that credit determines everything. Now in 2020, we have a very interesting situation. We had the health crisis, so that was no ordinary downturn. Banks tightened their lending standards as they saw the health crisis appear. But once the Federal Reserve and the Treasury started to flood the system with money, that's when lending standards came back down. So we're back to easy lending standards from the banks. Now, if you're so far enjoying this video, make sure to drop a like, especially if you want to see more content like this that's hopefully going to make you be able to navigate the stock market more efficiently. Now, the second signal that you can spot before a stock market crash is a rising dollar and falling gold. You tend to see investors flee to cash before big downturns. So let's take a look at 2008, for example, right here. And then we're going to go further back in the history. But first of all, right here, this is a very important moment for the dollar in 2008. You had a falling dollar environment for multiple years right here. And you can actually draw a nice trend line right here. We're going to call it like this. And you can see right here in July, you have a major breakout of that downtrend, telling you that investors are going from assets to the dollar. And so this is a risk off move, telling you that perhaps more downside in the stock market may be coming. And what happened after that breakout? We had the Lehman Brothers go bankrupt just a few weeks later, and the majority of the stock market crash of the financial crisis occurred after that breakout. Now, of course, this is not to be used alone. None of these indicators will be useful alone. You have to be able to assess the probability of a downturn occurring based on multiple factors that we're going to continue covering in this video. But the point is, not every dollar breakout leads to a big downturn. But if we take a look at 2000, for example, right before the dot-com bubble, you had a very strong dollar. I believe this was the top of the dot-com bubble. We can overlay the S&P 500 on this chart to take a look at that. And so you can see here, this was the top of the dot-com bubble throughout this period, and the dollar was very strong. It was in a massive uptrend throughout the process of making a long-term top in the stock market. So this type of move in the dollar, a big strong move in the dollar in combination with other warning signals, can potentially tell you to get out of the stock market. Now in 2021, the US dollar has started to break out, right? We were looking at this massive wedge pattern throughout 2020, and back in February, we broke out, back tested, and we had a nice resumption. And now we're testing these levels of support. So this is an incredibly important turning point for the dollar. We're at resistance. If we fail here, we've got nothing to worry about. We're still in a weak dollar environment, making lower highs along the way, and this is just a small counter trend rally. But if we start breaking out above here, backtest, and successfully break out, that could signal a risk off move in the markets, and combined with some other factors, that could be a warning signal for stocks. Now, the third point I want to take a look at is interest rates. Now, this is something that we've talked about before on the channel, and it's extremely important to understand. A rising interest rate environment is not good for the stock market. In fact, you can often spot significant tops in interest rates, like right here in 2007, right here in 1999, 1994, in 1987 here. These were all significant tops in the stock market. And this is very related to what we were talking about with the lending standards. Higher levels of interest rates means companies are going to have a harder time to borrow. And so when the stock market's gone too far and interest rates have risen, that's when you tend to have a significant top in the market. We can even take a look at that more recently right here with this top in interest rates right here. Let's overlay the S&P 500, and you can see that corresponds exactly to the top of the 2018 market here, right before the repo crisis. So rising interest rates creates harsher economic conditions and increases the likelihood of a pullback in the stock market. And you can take a look at that in reverse. You're not going to get a significant top in the stock market with interest rates very low. For example, right here in 2012, the stock market was climbing higher. It was on a massive rally since that bottom in 2009, and interest rates were still at rock bottom right here. So that was not the top. And same thing after this big leg up here throughout this period between June, August, and September, interest rates were at rock bottom. We were not looking for a significant top in the stock market because we were no longer in that bull trap scenario. We had avoided the panic sell scenario, and we were back in that uptrend with extremely low rates. That is a recipe for all-time highs. Now, the situation is obviously different with interest rates climbing extremely rapidly and the stock market at all-time highs. That is something to consider when taking positions in stocks in 2021. Now, the fourth point that I want to talk about in this video is the money supply. And this is what predicts depressions, not just stock market crashes, recessions, or small downturns, but actual depressions and huge economic downturns. So this is a chart of the money supply versus inflation. And so we've got the money supply, the M2 money supply in black right here. And so this is actually the year-on-year growth rate, telling you whether we're seeing an expansion in the money supply or a contraction in the money supply. So I want to focus on two periods in particular, and that is the Great Depression right here during the 1930s and the Long Depression right here between 1870 and 1878. That was the Long Depression right after the Civil War. And so you can see in both of these cases, the money supply was cut down. Now, before we take a look at that, I just want to discuss the fact that central banks are the ones that determine the money supply. The private banking system controls how much money circulates around the economy and whether or not we go into economic prosperity or economic depression. And so if we focus on the 1920s and 1930s right here, you can see the money supply was decreased throughout the end of the 1920s and even further into 1933. Now, the Great Depression had already started back in 1929, and despite that, it was further contracted until 1933. So this type of contraction in the money supply is what can trigger a depression. Now, during the Long Depression after the Civil War, you can see that we had massive deflation. And the single biggest economic reason for that is the contraction in money supply. You don't see it that much in this chart, but in 1873, something very interesting happened, and we call that the crime of 1873. And that was when Congress passed Coinage Act, where silver could no longer be used as a form of money, and it was only gold that could be used as a form of money, and that created a massive contraction in the amount of money that was circulating. So huge contractions in money supply lead to huge periods of economic downturn and depression. So the two biggest downturns that we've had in the past 150 years were triggered by a contraction in the money supply. So if you're looking for a depression throughout your lifetime, throughout the next 20, 30 years, this is the number one thing to pay attention to, a contraction in money supply. Now, if you enjoyed this video and you like the way we present content, you like the way we approach investing and trading in general, make sure to go and check out our website at gameoftrades.net. We've got a wide range of content and articles on our investment strategies, our trading strategies, our entries, our exits, our outlooks for certain asset classes like Bitcoin, where we're going to try and time the bull market to the best of our ability, just like we were able to time the entry of the Bitcoin bull market back in October. So if you're interested in finding out more about our research and strategy for the retail and investing community, make sure to test out our free trial. Now, that's about all I wanted to cover in this episode. If you enjoyed, make sure to drop a like and subscribe to the channel if you haven't already. Now, in the meantime, good luck on your trading and see you next time.